If you ask experienced investors one question, what is the simplest way for beginners to invest? You will hear the same answer again and again: index funds. In fact, many of the most successful investors in the world recommend them. Not complicated strategies, not day trading, not picking individual stocks, just simple index funds. But here's the strange thing: even though index funds are incredibly popular, many beginners still don't understand what they actually are. So in this video, we're going to break it down in simple terms. We'll cover what index funds are, how they work, why so many experts recommend them, and why they can be a powerful option for beginner investors. If you're new to investing, understanding index funds might be one of the most valuable lessons you can learn. Let's get into it. When most people think about investing, they imagine picking individual stocks, buying shares of one company, maybe a technology company, maybe a big global brand, and hoping that stock goes up. Sometimes this works, but there's a problem. Picking winning stocks consistently is extremely difficult. Even professional investors struggle to do it, because when you buy a single stock, you are placing a bet on one company, and companies can face many challenges. Competition, management changes, economic downturns, industry disruption. Even very successful companies can experience long periods where their stock performs poorly, which means relying on a small number of stocks can be risky. This is where index funds offer a different approach. Before we explain index funds, we first need to understand what an index is. An index is simply a collection of stocks grouped together. It tracks the performance of a particular part of the market. For example, some indexes track large companies, technology companies, the overall stock market. Instead of focusing on one company, an index looks at many companies together. If those companies grow overall, the index grows. If those companies decline, the index declines. So an index acts like a snapshot of the market. Now that we understand what an index is, an index fund becomes much easier to understand. An index fund is an investment fund designed to track the performance of a market index. Instead of trying to beat the market, the goal of an index fund is simply to match the market. It does this by holding the same companies that exist inside the index. For example, if an index contains hundreds of companies, the index fund will hold those same companies. So when the index goes up, the index fund goes up. And when the index falls, the index fund falls. In other words, an index fund allows you to invest in many companies at once with a single investment. This approach creates a powerful benefit: diversification. Diversification simply means spreading your investment across many different companies instead of relying on one. When you invest in a single company, your outcome depends entirely on that company. But when you invest in hundreds of companies, your risk becomes spread out. If one company performs poorly, others may perform well. This balance can make investing more stable over time. Index funds provide diversification automatically, which is one reason they are often recommended for beginners. Many investors believe they can outperform the market by picking the best stocks. Sometimes they succeed, but consistently beating the market over long periods of time is incredibly difficult. Even professional fund managers often fail to do it. This is one of the reasons index funds became so popular. Instead of trying to beat the market, they simply aim to capture the overall growth of the market. And historically, broad stock markets have grown significantly over long periods of time. This means investors who track the market can potentially benefit from that growth without constantly trying to outsmart it. Another advantage of index funds is that they are often very low cost. Traditional actively managed funds employ teams of analysts and managers trying to pick winning stocks. That research costs money, and those costs are passed on to investors. Index funds operate differently. They simply track an index. They do not require constant research or active decision making. Because of this, their fees are often much lower, and lower fees can make a significant difference over long periods of time, because every dollar paid in fees is money that is not invested and growing. Index funds are not designed for quick gains. They are designed for long-term investing. Over short periods, markets can move unpredictably. Prices rise, prices fall. News events create volatility, but historically, over long periods of time, stock markets have shown a tendency to grow. Index funds allow investors to participate in that growth without constantly changing strategies. Instead of chasing the next big opportunity, investors simply remain invested in the overall market. One of the biggest advantages of index funds is their simplicity. Investing can sometimes feel overwhelming. There are thousands of stocks, endless opinions, constant market news, but index funds simplify the process. Instead of researching dozens of companies, you invest in the market itself. Instead of constantly adjusting your strategy, you stay consistent. And sometimes the simplest strategies are the ones people can follow most easily over time. Many experienced investors recommend index funds for beginners, not because they are exciting, but because they are practical. They offer diversification, they often have low fees, and they remove much of the pressure of stock picking. For many people, index funds provide a straightforward path into investing, especially for those who want a long-term approach rather than short-term trading. The big idea behind index funds is simple. Instead of trying to find the single company that will outperform everything else, you invest in the market as a whole. This approach removes much of the guesswork from investing. It focuses on patience, consistency, and long-term thinking. And for many investors, that combination has proven to be very powerful. Investing doesn't have to be complicated. In fact, some of the most effective investing strategies are surprisingly simple. Index funds allow investors to own a wide range of companies with a single investment. They offer diversification, they often have lower costs, and they provide a straightforward way to participate in long-term market growth. For beginners especially, this simplicity can be incredibly valuable because successful investing is often less about complexity and more about consistency and patience. If you found this video helpful, consider subscribing. On this channel, we break down simple investing ideas designed to help beginners understand money and build long-term wealth. Thanks for watching, and I'll see you in the next video.